Rock, we've been around equity markets for a long time. It's deja vu all over again. It's like the 1990s. IPOs are back. Everybody's excited. Take us through your experience on IPOs and how are you feeling about it these days?
Well, it is deja vu all over again. I'm remembering the old 90s, the Morgan Stanley high net worth days, and everybody's clamoring for these IPOs. I think the thing that I remember most is that, you often have these big first days, it trades up, maybe even a big first 2 or 3 days. But as I monitored a lot of those IPOs and have been monitoring for now 20 plus years, you look around 6 months later, the prices tend to start to move down. I don't think that clients often understand that, and they're often discouraged from selling right away, and so they can't often monetize these initial surges in the first day or so of trading.
Yeah, you're right. You're an employee of a company. You got some stock. It goes public. It's great. It's up 50% in the first day, but you're precluded from selling oftentimes, or sometimes the broker puts restrictions and discourages it. And then you actually get kind of the insiders of the company, whether they're the private equity investor, the employee that owns shares, and they're subject often to a lockup period, which traditionally is about 180 days. And so to your point, Brock, as time goes on, investors start to get smart and go, wait a second, there's going to be a bunch of shares coming in a follow-on offering. Why do I want to buy it? I'll just wait for the follow-on offering when there's going to be more liquidity out there and maybe I get a chance at a better price. I think that's pretty common.
I listen. And that's why I think this conversation is just important with SpaceX coming to the forefront and some of these other large companies that are going to be coming in the pipeline. What should investors really be thinking about? What considerations should they be taking? What should they really be thinking about as they all clamor for the glitter, but not all that sugar kind of talk out there in the space?
Yeah, you mentioned the word the glitter, and you really need to separate a good company from a good stock. Just because a company's going public and it's a great company doesn't necessarily make it a good stock. Well, why is that? Well, a key driver is the valuation and what price it's going public at. The valuation incorporates the expected growth of the business. And so by subscribing to, I'm going to buy a stock at that valuation, I'm kind of implicitly saying, I agree that that company can grow at that rate or better, and therefore I think I'll make a pretty good return. And so you really have to separate, just because it's a good business doesn't mean the valuation of it makes it a good company. The other thing you have to think about is what got that company to that point and can it persist going forward? Case in point being management. You can have great founders that built a great business, but they got it to a certain point, and maybe that next stage, building out a bigger sales force, having good global presence, that may not be their forte. And are they the right management team to carry it to the next level? So you've really got to separate the good stock from the good company. The other thing that investors should really think about is also, where's that exposure to that IPO company in their portfolios? Might they also get some from an index? Brock, we've actually seen some changes with indexes and how they're thinking about including a company in it. What are you seeing on that side?
Yeah, listen, that's the different indices are putting these shares in at different times. I think the Russell is adding after the 5th day of trading, NASDAQ after 15 days, S&P, I'm not sure just yet, or they haven't sort of made that announcement. But all of a sudden, you can turn around and you've got a number of these super large IPOs now in your major indices, and you could end up with the S&P 500. Now 50% can be represented by the Mag 7 and a few of these other, super large IPO names. And that's just something investors need to take into consideration. We've been in this business a long time, MB, and we've looked at these indices over time and seeing that at one point, maybe banks dominated the index. And at one point it was, other types of industrial companies dominating the index. Technology has obviously become a much larger component of these indices. But as allocators, we need to recognize where those risks are. And if something can go up 150% in a matter of trading days, it can also go down 150%. So managing all of that volatility is really important for clients to understand.
Yeah, Brock, that's great perspective. For more information on this, check out our content online at composition.com for more information on our thoughts around the IPO market. And more importantly, if you want to have questions and talk more in depth, please reach out to your composition advisor.